Hello, it's Robert. I hope you had a great summer. I want to talk to you about the third quarter of 2024. So, quite a few interesting developments over the last 3 months that I want to talk to you about. And of course, now we're into the fourth quarter. It's the final quarter of the year. And yeah, there are definitely some things that are happening in the fourth quarter, like an election that we need to talk about. So, first things first, let's go and talk about how we did in the third quarter the last 3 months. So you can see that we've had a tremendously positive year so far during the first 9 months of 24. And if you recall, 2023 was also just a spectacular year. So for the 1 year mark, so basically over the last 12 months, ending in September 30th of 2024, US stocks, it's not too often we have such a strong performance in stocks like we've seen over the last 12 months, really over the last 24 months. And so you can see here that there are different types of stocks. We have US stocks, we have international, we have emerging market, and we also have real estate bonds as well. And you can see for not the first time, but this has been an ongoing trend now, and you're probably tired of me talking about it because it seems like every quarter, quarter after quarter, and year after year, and we can even see that this trend goes back at least 10 years. And if we had even a longer time frame, it even goes back more than 10 years. We're looking at least 15 years where US stocks have outperformed international, emerging market, and even real estate. And as you would expect, stocks outperform bonds over the last 1 year as well. That's to be expected. But what's really surprising is the fact that US stocks continues to outperform all of these other asset classes. And not just by a little bit. Look at over the last 5 years, US stocks up over 15%. The next closest asset class that we have here is international stocks. It's about a half as much of a return as US stocks. And look at emerging market, a third of the return. Real estate, barely squeaking by with a 2.5% return. Now let's look at a 10-year window. Here we have US stocks up almost 13%, international up half that amount. Emerging market still underperforming. Real estate less than half as much growth as US stocks. So again, this is something I've been talking about for quite a while. Most of the portfolios, I would say, are overweight to the United States versus international and certainly versus emerging market or real estate. I have for a very, very long time believed that the US market was going to outperform, and I still think it's going to continue to outperform. So this is something that we have all benefited from. So now let's look at one of my favorite slides. Every quarter I say this, but it really is interesting. What this shows is just for the last 3 months, you can see various headlines as they happen, and then you can see what the market does as a result. And more often than not, you will see a really negative headline. So let's take a look at this headline, for example. This occurred in August. Stocks extend ugly week of losses amid economic uncertainty. So imagine you wake up, you're drinking your coffee, and you read this headline. What does that make you feel? Probably not confident. My guess is you read something like this or you hear something like this on YouTube or CNBC, and it causes you fear, anxiety, uncertainty. This occurred right here. What did the market do? Did the market see this kind of a headline and and drop because everyone started selling? No. The market actually went up from this headline. What's my point? My point is, well, two things really. The first is if you hear or read a really negative headline, resist the urge to act on it because more often than not, the action is going to hurt you financially. The second thing I would say is do your best to avoid reading or listening to headlines because they are in the market to capture attention. And a headline of, hey, things might not be perfect, but just go ahead and stick in there with your investments is not going to get many clicks. So they are constantly trying to get your attention through fear. And that fear, if acted upon, more often than not, will lose you money. So I just said that US stocks over the last 3 months, and really for the last 15 years, have outperformed. But over the last 3 months, there are different types of stocks. So which ones did better than others? So we can see that there has been a big gap within US stocks. So look at large US growth stocks, positive return of 3%. But look at what small value stocks did, 3 times the return compared to large cap growth. This is why we can't just say, hey, we like US stocks. It's important to be diversified within US stocks by having large companies as well as small companies, growth as well as value. It's that combination in your portfolio that produces such strong returns over longer periods of time. Because you can see down here, so the best performing over the last 3 months was small cap value. We can see that here, over 10% return. Well, here we have small value, and let's look at a longer time frame. So instead of 3 months, let's look at, I don't know, maybe 3 years. Okay. So we can see that over a 3-year period, each year, small value produced 3.77% return. Okay, that's not bad. But now let's look at, as a comparison, right? Because over the last 3 months, large growth was produced the least amount of return when it comes to US stocks. And you can see large cap growth over the same 3-year period. Look at that, 12% return. So this is why it's really critical not to what they call chase returns. And chasing a return would be, well, what's doing well right now? Well, if you looked at this, you would go, well, small cap seems to be doing really well right now. It was up 10%. Maybe I should sell all of my large cap growth and move it all into small cap value since it's doing so much better. But that's taking a much too short time frame. We have to look at a longer time frame. And that's why we look at 1 year, 3 year, 5 year, 10 year. And if we want to look at it 10 years, small cap value up 8%, large cap growth, double the return, 16.5%. Again, this is why we are diversified within US stocks. So this is an interesting slide because it gives us what this doesn't, and that is a longer time frame. This is just looking at 3 months. It's far too short. What this looks at is not 3 months, but 50 years. 50 years going back to 1970. You can see these dips that we have. Look at this Black Monday. Look at that drop. I remember exactly where I was when this happened. Do you? Big, big drop. We had the tech crash. Remember? Late 90s, early 2000. Big crash. We had the financial crisis. Big drop. Of course, we had the pandemic right here. Big drop. What is each of these big drops followed by? Well, certainly choppiness, right? Ups and downs, ups and downs, ups and downs. But over a longer stretch, what do we get? we get growth. That growth might not occur the next day, the next week, the next month, the next quarter. It could take a few years. Look at this tech crash. That didn't recover for several years. Sometimes the recovery is much quicker. So the financial crisis, that went on for a couple of years. The pandemic, that went on for a couple of months. Yes, the pandemic went on for a couple of years, but the stock market crash and then subsequent growth really took only a couple of months. So the point is, there is volatility. You've been with me long enough to know that there will always be volatility. There will be times, months, where you look at your statement and there are losses. I haven't seen them a whole lot recently, but they will come. That I promise you. What this slide represents is each of these bars represents a year and the return for that year. If the blue bar is above this line, that means it was a positive year. So all of these are positive, and we have a few negative years. So right off the bat, what do you notice? Well, on average, the stock market is up more often than it's down. That's the first thing. The second thing you notice is all these red dots. These red dots represent, in that particular year, the market was down by that much at some point during that year. So this is a great example. So I was talking a moment ago about the pandemic. So that was 2020. At one point, specifically it was in March of 2020, the S&P 500 was down 34%. That 34% happened in just the span of a few weeks. The market lost 34%. But then how did the year end up? So come December 31st, 2020, it wasn't down 34%. The market was actually up 18%. So that's the second thing to notice about this, is that you will often have a lot of volatility, right? But more often than not, the market actually produces a positive return for the year. So what this should tell you is stick in there. Everyone hates losses. But if you can stick in there, more often than not, there will be a positive return for the year. And this is a great slide because it shows the number of pullbacks. A pullback, at least how I'm defining it here, is when the market drops by 5% or more. And each of the bars represent the number of times that year that we saw a decline by 5% or more. Look at this outlier, 24 times. 24 times. This would have been in 2008, 2009 here during the financial crisis. That happened. And we can see the average is just under 5 times a year that the market pulls back 5% or more. The last couple of years, pretty steady, under average. So this is probably the most consequential slide, certainly in this presentation, maybe of any investment presentation that you'll see. What this shows is the S&P 500. This blue background here, like here, represents the index. So this is what the S&P 500 returns. The darker blue that you see here represents how the index is actually performed over that period of time. And you can see this disparity between the earnings and what the index is doing. So right now, there's a little bit of gap there. Sometimes what you'll see is a much larger gap. So for example, just recently, we had earnings of the S&P 500 way up here, and it was climbing, and at the same time, the market was falling. And you may remember, but I did a video about this, and I said one of three things are going to happen. Either earnings, corporate earnings, will either come down, the stock market will go up, or some combination of the two. Well, now that we have some history, we can actually see what's happened. The stock market has gone up to meet the earnings. And that's what you want to see, because over longer periods of time, the most influential thing that we have are earnings as it relates to how the stock market does. There's a lot of things that can affect what the stock market does day to day, but over longer periods of time, it all comes down to earnings. Earnings, can't even spell earnings, INGS. There. It all comes down to earnings. And so right now, the S&P and earnings have a very, very short gap between them. That's what we like to see. The big news last quarter was what the Fed did in their September meeting. So they cut rates by 50 basis points, which is 0.5%. So this was the first time in 4 years that they lowered interest rates. And if you recall, they increased interest rates to do what? To tame inflation. Inflation was getting very high, and their mandate at the Fed is to make sure inflation doesn't continue to grow. So they have a few different tools in their toolbox. One of them is increasing interest rates. And the idea there is as you increase interest rates, it makes things like borrowing, like being able to afford a new house, a new car, companies borrowing money to expand. It basically makes that more expensive and less likely for people to do those things. So, why would they want that? Well, when the economy grows less quickly, because fewer people are buying things, it can cut inflation. And that's exactly what's happened over the last few years. They increased rates and the economy slowed. Not so much yet that we have a recession, but it slowed enough to bring down the rate of growth in terms of inflation. So that this is where we are right now. And so many are looking at what the Fed's done over the last few years and they're applauding them because while they were late to start raising interest rates, many feel like they've orchestrated a very soft landing of the economy, not raising rates too much or for too long that it creates a big recession, but raising them enough that it slows the economy in order to reduce the rate of inflation. So, speaking of recessions, this slide here shows leading economic indicators. There are dozens of indicators that economists will look at to try to predict what's going to happen in the future. And the indicators that are looking at how the economy is doing are called leading economic indicators. They're trying to look out into the future and get a feel for what might happen. And you can see that these leading economic indicators are pretty darn accurate because each time these indicators goes below this line, it indicates that there may be a recession. So here it dropped below, it went from here all the way down here, and it turned into this sort of this orange color. And when that happened, we had a recession. It dropped here into the orange. These gray bars represent a recession. It spiked and then dropped again into the orange area. And guess what? Had a recession. Dropped here into the orange area, followed by a recession. Here, recession. Dropped, recession. Dropped ever so slightly, initially, an immediate recession. Look at where we are now. Big drop for these leading economic indicators. The big question is, will we get another one of these ominous gray bars, which represents a recession. That's the $1,000,000 question. And so with the data that we have, we are showing that the economy, yes, is slowing, but there is a very good chance that we can get through it without going into a recession. That, of course, remains to be seen. Every time we've dropped below, we've had a recession. So if we do get one, I would not be surprised. But so far, the labor market has held up. Earnings have held up very strongly. Spending has held up. All of these things that indicate that the economy is not very weak. In fact, it's pretty darn strong right now. If that can continue, we will avoid a recession. So speaking of the Labor Department, we have unemployment rates. So you can see here, this is a bit of an aberration. This was COVID. Everyone was stuck at home, couldn't go to work. Obviously, unemployment went through the roof. But where are we today? We can see that unemployment dropped drastically after that. This is what caused, or at least helped cause, some of the inflation that we saw. And we saw an uptick. This is actually exactly what the Fed wanted to see. They wanted to see a labor market where there was higher unemployment, because again, that helps reduce the growth of inflation. Consumer price index, that is inflation. Inflation is measured by the consumer price index. You can see during the COVID and post-COVID years, massive, massive spike of inflation. And I think we all felt it. We all experienced inflation because we hadn't had inflation really since the 70s. We had years of just really tepid inflation, almost a Goldilocks scenario. But we felt it here. And guess what? No one liked it. And so the Fed came in, they increased interest rates, and what happened? Well, almost magical. We had inflation drop. That's exactly what they were hoping to achieve. And so far, so good that that's exactly what's happened. All right, switching gears just a little bit. This is a sort of a fun slide because it just shows year to date. So from January 1st to September 30th, what asset classes have done the best. And as I mentioned earlier, U.S. stocks represented by the S&P 500, emerging market actually doing pretty well. Balance just means a balanced portfolio between stocks and bonds. We have international stocks. We have small cap, which less than half of the return of U.S. large cap. We have commodities, and then we have fixed income, which are bonds. We don't expect bonds to perform double digits in returns. Bonds are really about income and stability in a portfolio. So it's nice to see a positive return for bonds. So that concludes this video summary of the third quarter and year to date. We have what I'm sure will be an exciting fourth quarter of 2024. I will keep you abreast of any changes. If you want to speak about your portfolio, the economy, or anything in this slide, please reach out. I would love to talk to you. So until next time, I hope you have a great autumn, and I hope to talk to you soon. Thanks so much.